Welcome to the BS Banking Show. Good to have you on our show after a long time. And now, it's been 3 years since you took charge at the helm of the bank, and it's been a period of growth as well. This comes at a time when others were more cautious. How would you sum up your approach to banking over the last 3 years?
So firstly, thanks a lot for inviting me to this show. Really appreciate it. As you said, our growth engine has been accelerating even as we made significant headway during these last 3 years on our legacy issues. We have been cautious, but we have also been nimble to capture opportunities of growth. We have put the legacy issues of asset quality behind us, sharpened our focus on retail with an asset-led strategy in the semi-urban and the rural geographies. We have tapped higher and better rated corporates in the wholesale banking side. We introduced a mid-corporates, sectoral focus in the wholesale banking for the first time. We created a new SME template and so on and so forth. We have also built a strong balance sheet with improving return ratios to drive our aspirations. I believe very strongly that now our asset quality is perhaps one of the best in the business with adequate capital position, improvement in return ratios. Our PCR has improved. Our capital asset ratios improved from 15.8 to 18.54. CET1 improved from 11.27 in financial 19 to 15.24 in financial 92, and our credit cost has reduced from 1.91% in financial 19 to 1.04% in financial 22. And over and above that, more importantly, we are today sitting on a pretty large provision, which also obviously beefs up the balance sheet in case, as the macro is looking a bit tougher, if there were problems, our balance sheet has the strength to tide over any crisis which might come our way. Analysts have been acknowledging our improving liabilities, NIM and return ratios, our strong presence in the payment ecosystem and the credit card space, and improving digital capabilities. We have recorded, frankly, stellar performance in deposits. Our deposits growth was 18% year on year in financial 22. We have seen an uptick in our advances growth also. While we have a very large bouquet of initiatives across the bank, our core leadership is focused on 19 transformation initiatives within the bank at both business and function levels. 2 of these initiatives are looking at how Axis Bank can create areas of distinctiveness, something which Axis Bank will be known for. And finally, we just have to become a better execution engine. So there is a lot of focus on just improving the execution capabilities of the bank. We have also made significant investments in digital banking, on cloud, analytics-driven decision-making, and they have helped us deliver a strong performance.
Can you give us a quick overview as the economy as it stands today, given the switchover in the interest rate cycle and the post-Ukraine war?
Well, as you've seen, many G10 central banks, especially the Fed, are likely, they have said it in so many words, to tighten the monetary policy aggressively, using both policy rate hikes and running down balance sheets to tame inflation levels not seen in a generation. And as many in the market expected, Fed FOMC announced a substantial 75 basis points rate hike. They talked about a roadmap also where many more hikes are going to happen in a relatively short period of time. You yesterday saw UK and Switzerland raising rates. You combine this with supply disruptions of energy and re-engineered value chains. Global growth and merchandise trade are expected to slow even further in 2022. And this is much earlier than expected. You're also seeing that a lot of economists now globally have started talking about likelihood of a recession increasing manifold in the last couple of months. And India is obviously cannot be devoid of all these problems. India is likely to be affected by global spillovers via commodities, especially energy, trade, and financial channels. A fundamental market tightness for oil, exacerbated by periodic disruptions, and summer travel demand is likely to keep crude prices high in the near term. And the crude prices are high even though China has seen some specific shutdowns around COVID. We believe China's growth revival is again expected to push metal prices, which have actually cooled over the last couple of months. While RBI has retained its financial year 23 GDP growth projection at 7.2%, we do believe that there are downside risks to this, although the activity in the first 2 months has been quite robust. Persistent high headline and core inflation remains a concern. High input costs have become a problem for MSMEs in particular. Again, RBI's forecast a CPI inflation of 6.7% for financial 23, assuming an average oil price of $105 a barrel. Now let's see how this plays out. Our expectation is that the likelihood of the average price for India for oil will be higher than this number. We also believe Central's fiscal deficit will be higher than the 6.4% budgetary estimate. So there are risks in the macro. And given the risks in the macro and the clear desire expressed by the governor to bring down inflation and actually be proactive about it, given that inflation is way higher than expected, we have to be watchful. We do believe that there are enough variables out there which are uncertain. There is a huge amount of unpredictability and volatility. Asset prices, which had been going up forever, are going to see a deflation. Some of the lofty valuations are going to come down. Raising capital will become an issue. Interesting times ahead of us. I would add in the end that all this uncertainty tends to favor countries and institutions which are financially stronger, which are bigger, have a bigger say in the marketplace. And in that sense, I think this could present an opportunity for the larger institutions in India, including in the financial space, to actually gain market share if this macro was to play out or the macro was to remain that uncertain over a reasonable period of time.
A few banks have either decided to switch over the ratio a bit lower or go easy. Now, what's your view, since we are exactly not out of the woods as far as this economy is concerned?
You're absolutely right. We have been working on strategies to grow the retail book share in our total portfolio. The outcomes are obviously in line with our strategy. It's also been, in a way, helped by the fact that as we pivoted our wholesale book to higher quality corporates because of excess liquidity in the system and RBI pushing down rates, some of the corporates were able to borrow money at interest rates which did not make sense for us. So we obviously have stayed away from a lot of the deals out there. So as the rate of growth in the wholesale book slowed down and retail continued to grow well, the share of retail has also gone up. Also, as you fully understand and appreciate that the private capex demand has not picked up. So overall demand from corporates is more for refinancing rather than financing new capex. And as a result, the combination of all this has been that our retail book has grown. Our retail business is one of the larger businesses in the country. If you look at it on a standalone basis, it is granular, it has higher margins, and does provide very good risk-adjusted returns. As Delta, the Delta strain played out in the first couple of months last year, post that the customer sentiment and the demand has improved. We also observed that the retail lending is consolidating, and we are benefiting from this trend. So we are quite confident of healthy growth in this space. We do believe that private capex will come back. We do believe that wholesale will start growing. We also believe that India will be one of the fastest growing economies in the world. And as private capex and some of the government capex starts flowing through, the balance between retail and wholesale will hopefully be maintained. So we expect retail would not cross more than 60% of our overall portfolio, but it could go a couple of percentage points up and down depending on how Indian economy performs.
Now, coming specifically to the Citibank deal, how does it fit into the Burgundy positioning of Burgundy, the premium offering from you?
So the Citi Wealth Management franchise in India is a perfect fit and will be, we believe, very, very accretive to Axis Bank's Burgundy proposition. Each customer segment in Citibank complements the corresponding segment we have in Axis. Namely, if you look at Citibank, a Citi Gold private client, it corresponds to Burgundy Private. Citi Gold corresponds to Burgundy. Citi Priority is same as Axis Bank Priority. And salary, which they call Citi Suvidha, is equivalent to Axis Bank salary. There could be some clients in Citi Gold and Citi Priority who could move to a higher proposition at Axis. This will ensure that the existing Citibank customers actually get upgraded in terms of what kind of services and value proposition they could get from Axis. Over the last 5 years, just to give you some data on Burgundy, we have grown organically our Burgundy franchise to rupees 2.6 trillion of AUM, which is a 27% CAGR growth. The Citi deal will add another 1.1 trillion as of this data as of March 22. So collectively, this catapults us to the number 3 player in the wealth management space in the country. And obviously, we believe that if you look at the time it has taken for us to build this Burgundy franchise, which is quite short, and Citi has been in this business for a long period of time, we have a perfect platform to go and gain even more share in this space as we move forward.
How do you see the MDR issue playing out on the UPI credit card linkage?
Yes, so MDR will continue to be a part of any credit card transaction. However, a large segment of merchants will have come into the fold of digital payments with UPI, especially small merchants. Now, these transactions come with zero MDR, and any new solution market expansion will have to factor this in. The MDR will have to be suitably modified for these set of merchants as a cohort. And frankly, the solution has to come, the industry has to look at it as a unit, and we'll have to devise a solution which takes care of these 2 points. And I'm sure that we will arrive at a suitable solution. Apart from this, with a base of over 30 crore UPI customers and the fact that this base can be underwritten, we have conducted test programs on the base and have seen extremely good results, which makes this entire proposition very interesting and a step forward for both credit cards as well as the UPI market. Now, if you look at some of the announcements which have happened to win on the credit card space, on the RuPay side, the MDRs are lower. So in that sense, I think the industry obviously is watching the space very, very closely. We are one of the largest players in the credit card space. There is obviously a clear need for credit cards, especially when you travel abroad and especially when you're doing larger transactions. So I think both can coexist, but then yes, this MDR issue has to be sorted out.
Amitabh, it was nice talking to you. Hope to see you soon. Have a good day.
Thank you so much, Raghu. Always a pleasure. Thank you.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.